In 2022, 7 of the world's largest central banks raised interest rates all at the same time, in one single week, sending shockwaves through financial markets from Wall Street to Tokyo. Bitcoin dropped more than 75% from its all-time high as government buildings across Washington, D.C. and Frankfurt lit up with emergency financial meetings held far from public view. Welcome to the secret treasury, where money, influence, and history intersect. Subscribe to trace the flow of power behind the headlines. This story does not begin in 2022, it starts decades earlier, inside United States Treasury printing rooms, where dollar bills rolled off presses at a pace the modern world had not seen. After the financial crisis of 2008, the Federal Reserve in Washington, D.C. began buying government bond certificates and pumping trillions of fresh dollars into the American financial system. Bond certificates filled the balance sheets of major banks on Wall Street, while ordinary people at grocery store checkout counters quietly noticed each dollar was buying a little bit less. By 2020, as hospital buildings around the world filled with seriously ill patients, governments on every continent began printing money faster than at any point since World War II ended. Dollar bills left United States Treasury printing facilities in Washington, D.C. at record speed, as Congress signed off on emergency spending packages worth trillions of American dollars. Stimulus checks landed in mailboxes across American suburbs, while factories in China and Germany sat completely idle, opening a gap between the money supply and the actual goods available. Shipping containers stacked at the port of Los Angeles sat still as global supply chains broke apart, leaving retail store shelves empty across the entire United States for weeks at a time. Empty supermarket shelves, photographed in stores across New York City, spread widely online, telling a supply crisis story that government offices in Washington, D.C. were still struggling to measure. By early 2021, lumber prices at hardware stores in Texas had risen over 300%, and used car lots across California displayed vehicle prices that nobody had ever expected to see. Economists inside the Federal Reserve building in Washington, D.C. watched inflation charts climbing on their monitors and debated quietly among themselves whether the pressure was temporary. Federal Reserve Chair Jerome Powell stood before microphones in Washington, D.C. in 2021 and told the nation that rising inflation was transitory, a word that global financial markets then held tightly. The word transitory spread across television screens worldwide as bond traders in London and New York quietly began repositioning their portfolios and waiting for clearer and more reliable data. Monthly inflation reports from the Bureau of Labor Statistics in Washington, D.C. showed numbers climbing faster than any public government forecast had previously suggested they would reach. By December 2021, annual inflation in the United States reached 7%, the highest reading on any official government chart since January of 1982, nearly 4 full decades earlier. Inflation charts from 1982 pinned on economist office walls showed gasoline station price signs and grocery receipts marked with numbers that most working Americans had completely forgotten. In the 1970s, Federal Reserve Chair Paul Volcker sat in a Washington, D.C. office and chose to raise interest rates above 20% in a determined effort to force inflation to stop rising. The Volcker decision caused unemployment lines to form outside government employment offices across every major American city as the economy entered a deeply painful contraction in the 1980s. Car factories in Detroit fell silent, and car lots sat empty as workers stood outside unemployment offices across Michigan in long lines, holding printed application forms in their hands. The painful inflation lessons of the 1970s and 1980s were written into economics textbooks on university shelves worldwide, but applying those lessons in the economy of 2022 would not be easy. By January 2022, global supply chains were still broken, energy prices were rising fast, and the Federal Reserve in Washington, D.C. had still not raised rates by even a single basis point. Energy prices on commodity trading screens in New York showed natural gas and crude oil climbing sharply as demand recovered, but pipelines and production rigs had not rebuilt their full capacity. Natural gas pipelines running across the European continent carried fuel from east to west each day. But political tensions growing near the border of Ukraine were building towards something major. On February 24th of 2022, military vehicle columns crossed into Ukraine, and commodity market screens across the entire world immediately began rising as traders everywhere recalculated supply risk. Grain silos across the wide farmlands of Ukraine and Russia together held enough wheat to feed large portions of Africa, Asia, and the Middle East for an entire full year of normal consumption. Wheat prices at the Chicago Board of Trade jumped more than 50% in just a few trading days as floor traders studied printed maps and began calculating the full scale of supply disruption. Sunflower oil bottles vanished from supermarket shelves across the United Kingdom and Europe as major distributors began rushing to prepare for what could become an extended supply shortage period. Fuel pump prices in California crossed $5 per gallon for the first time in the recorded history of that state, and long lines of vehicles formed at gas stations across the region. Gas station price signs along American highways climbed weekly, and news cameras zoomed in closely each evening, while television anchors explained carefully the economics driving the rising costs. The Federal Reserve in Washington, D.C. had run out of time to wait. Officials began preparing for the most aggressive interest rate raising campaign the country had faced in more than 40 years. In March 2022, Jerome Powell walked to a podium in Washington, D.C. and announced the first interest rate increase in years, raising the federal funds rate by exactly 25 basis points that day. Financial reporters in the front rows of the Washington, D.C. press conference wrote quickly in their notepads, as Powell confirmed that additional and larger rate increases were already being planned. Bond markets in New York and London began repricing assets immediately as traders recalculated the value of every government bond certificate held inside the largest institutional investment portfolios. Government bond prices fell on trading floor screens across New York City as yields rose sharply, and the well-established inverse relationship between bond prices and bond yields played out in real time. Bitcoin price charts on digital platforms showed the cryptocurrency falling from near $70,000 in late 2021 to below $40,000 by the middle of March 2022 as conditions deteriorated. Cryptocurrency screens in offices across Miami, where many digital asset companies had relocated, showed mounting losses as investor appetite for risky market exposure disappeared rapidly. In Frankfurt, Germany, officials inside the European Central Bank headquarters began examining inflation data showing that prices across the entire Eurozone had risen at a dangerously fast pace. The European Central Bank building in Frankfurt held urgent meetings where officials studied printed charts showing energy price inflation, spreading rapidly across Germany and France simultaneously. In London, the Bank of England near the Thames River had already raised its benchmark lending rate in December 2021 and was now preparing to move that rate higher again at a much faster pace. Bank of England officials carrying document folders entered meeting rooms in London, while currency traders at screens outside carefully tracked real-time movements in the British pound sterling. Across the Atlantic in Ottawa, the Bank of Canada building lit up with activity as Canadian monetary officials prepared emergency rate increases aimed at controlling housing and daily food costs. Canadian housing reports showed home prices in Toronto and Vancouver had more than doubled in just 2 years, while average worker wages across the country had barely increased by a meaningful amount. In Sydney, the Reserve Bank of Australia watched imported inflation arriving through the busy port of Sydney as the cost of fuel, electronics, and basic household food items all rose together. Australian grocery store receipts, photographed by shoppers and shared on social media platforms, showed dramatic price increases for everyday items including bread, eggs, and bottles of cooking oil. In Stockholm, the Riksbank, one of the oldest established central banks in the world, began reviewing data showing Swedish consumer prices had reached their highest recorded level in 30 years. Swedish central bank officials inside the Stockholm Riksbank building examined historical records extending back into the 1990s and compared those old charts with what current monitors were showing. In Zurich, the Swiss National Bank, known internationally for careful and conservative monetary policy, found that holding steady and doing nothing was simply no longer a viable policy option. The Swiss National Bank in Zurich held urgent meetings not seen since the Swiss franc revaluation shock of January 2015 had caught international currency markets completely off guard worldwide. Then came the week that changed the global conversation about money forever. In June of 2022, within 7 consecutive days, 7 major central banks each announced large interest rate increases. On June 15th of 2022, the Federal Reserve in Washington, D.C. raised rates by 75 basis points, the largest single rate decision made by that institution in any one meeting since the year 1994. Television screens in American living rooms showed Jerome Powell standing at a podium with the Federal Reserve seal, confirming to the country that a truly significant historic decision had been made. Jerome Powell spoke before cameras in Washington, D.C. and stated clearly the Federal Reserve was fully committed to bringing price inflation back down to stable and acceptable levels for all Americans. Within hours of Washington, D.C., the Bank of England in London raised its own benchmark lending rate, adding another powerful central bank voice to a global chorus, all moving in the same direction. Central bank buildings in London, Frankfurt, Ottawa, Stockholm, Sydney, and Zurich all issued rate decisions within those same 7 days, creating synchronized global tightening not seen in decades. The word synchronized appeared in headlines across the Financial Times in London and the Wall Street Journal in New York within 48 hours of all major central bank rate decisions being publicly announced. Bitcoin price charts collapsed that same week, falling below $20,000 as large institutional investors moved their capital rapidly and decisively away from high-risk digital currency assets. Cryptocurrency exchange platforms in San Francisco and New York showed trading volume spiking as prices dropped sharply in one of the deepest and most consequential collapses the digital market had recorded. A cryptocurrency lending company called Celsius Network froze all customer withdrawals that week, and account screens worldwide showed locked balances that depositors in every country simply could not access. Celsius customers in cities from New York to London stared at frozen account screens as major financial news outlets published urgent breaking reports about exactly what had happened inside the company. The collapse of the cryptocurrency project called Terra Luna in May 2022 had already seriously damaged digital asset markets before the central bank decision week even arrived that following June. Terra Luna price charts shared by financial journalists showed a vertical price collapse that erased approximately $40 billion in total market value within only a very small number of trading days. Bitcoin had survived previous crashes, including an 80% price drop from late 2017 into 2018, and holders of the asset continued to argue confidently that the same recovery pattern would repeat. Bitcoin recovery comparison charts covering the market cycles of 2013, 2017, and 2020 were shared across financial media as professional analysts searched for patterns that might reveal what came next. But 2022 was different from all earlier Bitcoin market cycles because for the first time ever, large institutional money had entered and stayed inside the cryptocurrency market starting from around 2020. Corporate treasury documents publicly filed by Virginia-based company MicroStrategy showed billions in Bitcoin purchases, made at price levels far above where the depressed current market was now trading. MicroStrategy regulatory filings showed enormous Bitcoin asset holdings that had turned deeply negative as price screens reported figures consistently well below the original documented purchase costs. Pension managers in Chicago and Boston, who had placed retirement fund allocations into Bitcoin, were now receiving concerned calls from clients watching their account statements change week after week. Retirement account statements delivered to households across the United States in June 2022 showed painful results as both traditional stock portfolios and cryptocurrency holdings fell sharply together. The S&P 500 index displayed on financial television screens entered official bear market territory by June 2022, having declined more than 20% from the index high reach just months earlier. Charts showing the S&P 500 falling alongside Bitcoin told a story of correlated risk that surprised investors who had believed holding both assets together would protect their total portfolio value. The correlation between Bitcoin and technology stocks on the Nasdaq exchange in New York showed that during periods of serious market stress, most major asset classes tend to fall sharply and together. Federal Reserve reports showed the total United States money supply had grown by more than 40% between the start of 2020 and the end of calendar year 2022, an extraordinary peacetime expansion. Federal Reserve money supply charts visible on economist office walls showed a near vertical upward line beginning from March 2020, a pattern that economic researchers noted was almost never seen in peacetime. The velocity of money, measuring how quickly dollars move through an economy, fell, according to Federal Reserve data, to its lowest recorded level in the entire modern history of that institution. Economists at major research institutions published papers arguing that extreme money supply growth, combined with shattered supply chains, had created a more severe inflation crisis than models had predicted. Academic papers and congressional testimony transcripts together describe central banks worldwide as having fallen dangerously behind the inflation timeline by choosing to delay their response far too long. The Federal Reserve published comparison data showing the 2022 rate hike campaign was proceeding faster than any period since Paul Volcker had led that institution back in the early 1980s, decades before. Federal Reserve meeting transcripts from the Volcker era, preserved in public archives in Washington, D.C., showed that every campaign of aggressive rate increases had always carried significant economic costs. Reports from the International Monetary Fund warned that synchronized global rate increases of this speed and scale carried a real risk of pushing the broader world economy toward a significant recession. International Monetary Fund forecasters in Washington, D.C. published revised global growth projections in the summer of 2022, showing downward adjustments for economies across nearly every major world region. Mortgage application desks at lending institutions across the United States watched new home loan applications fall sharply through 2022 as rising rates pushed monthly payment amounts far beyond household reach. Housing market data in real estate industry reports showed for sale signs remaining on American front lawns far longer as the long era of historically low mortgage interest rates came to a visible end. Technology company offices across Silicon Valley posted layoff announcements as rising borrowing costs slowed the flow of venture capital investment at a pace the sector had not experienced in many years. Venture capital offices in San Francisco recorded a sharp and sustained decline in startup funding rounds through 2022 as investors earning higher returns from government bonds began cutting their budgets. United States Treasury bond yields on financial market screens offered returns above 4% for the first time in a decade, pulling cautious investors away from riskier assets, including Bitcoin, firmly. 10-year United States Treasury bond yield charts on Wall Street trading screens showed the steepest single-year rise recorded in that market in more than 4 full decades of modern financial history. Bitcoin price charts closed the year 2022 near $16,000. A fall of more than 75% from the all-time high of November 2021, marking one of the most painful calendar years in that market history. The question that remained on trading screens, in bank offices, and in homes around the world as that difficult year drew to a close was both simple and profound. Had Bitcoin actually survived the inflation shock? The year 2023 began with Bitcoin price charts sitting near $16,000 on trading screens across the world, and very few professional analysts were making confident predictions about what came next. Financial news studio sets in New York City lit up each morning with anchors asking the same question out loud. Was the worst of the Bitcoin collapse finally over, or was there more pain still coming? The Federal Reserve building in Washington, D.C. was not finished. Officials inside that building had already committed publicly to raising interest rates further until inflation submitted to their will. Printed Federal Reserve policy statements released in January 2023 made clear that the institution was still firmly in inflation fighting mode and that the pace of rate increases would continue forward. Inflation charts displayed on financial television screens across the United States showed that the Consumer Price Index had peaked near 9% in June 2022 and had begun a slow and uneven decline. The Consumer Price Index chart, printed monthly by the Bureau of Labor Statistics in Washington, D.C., showed a number that was moving downward but was still far above the 2% target the Fed wanted. Inside the Federal Reserve building in Washington, D.C., officials studied printed data pages showing that shelter costs, meaning the price of rent across American cities were still rising fast. Rent prices in cities like New York, Miami, and Austin showed on real estate market screens that even as overall inflation eased, millions of people sitting at kitchen tables still felt the full pressure. Working families across the country opened monthly bills at kitchen tables and found electricity costs, grocery totals, and insurance premiums still running far above where they had been just 2 years before. The Federal Reserve in Washington, D.C. raised rates again in February 2023, again in March, and again in May, pushing the federal funds rate above 5% for the first time since the year 2007. A federal funds rate above 5% meant that money sitting inside a simple savings account was finally earning a meaningful return for the first time that an entire generation of Americans could remember. Bank branch windows across American towns displayed printed signs advertising savings account rates above 4 and 5%, a sight that most people walking through those doors had never seen before in their lives. The sight of high savings rates posted on bank branch windows pulled billions of dollars out of riskier investments as ordinary households began moving their money towards safer government-backed options. United States Treasury bond auction rooms in Washington, D.C. processed enormous volumes of new purchases as investors worldwide rushed to lock in yields that had not been available in well over a decade. Bitcoin price charts on trading screens responded to the higher rate environment by continuing to trade sideways through the early months of 2023, oscillating between $16,000 and $25,000 weekly. Digital asset investors watching their screens in offices across Miami and San Francisco noted that Bitcoin was not continuing to collapse, which some analysts described as a sign of underlying resilience. Meanwhile, inside the United States banking sector, something unexpected was building quietly behind the walls of a mid-sized financial institution located in the state of California during early 2023. Silicon Valley Bank, a financial institution in Santa Clara, California, that served many technology startup companies, had placed a large portion of its customer deposits into long-term government bond certificates. When the Federal Reserve had raised interest rates rapidly, the market value of those long-term government bond certificates held by Silicon Valley Bank had fallen sharply on financial reporting screens. Government bond price charts showed that as yields climbed across 2022 and into 2023, the market value of existing long-term bonds fell in a direct and mathematically predictable relationship with each rate increase. Silicon Valley Bank executives sitting in offices in Santa Clara watched their bond portfolio values decline on financial screens and faced a situation that regulators later described in official documents as precarious. In March 2023, news of the bond portfolio losses at Silicon Valley Bank spread rapidly across social media platforms and technology industry communication channels used by the startup community in California. Within 48 hours, depositors across the country began attempting to withdraw funds from Silicon Valley Bank branches and online portals as concern spread faster than any official statement could manage to contain. Lines of people formed outside Silicon Valley Bank branch locations in California as customers with accounts at the institution arrived hoping to access their money and confirm their deposits were still protected. Regulators from the Federal Deposit Insurance Corporation arrived at Silicon Valley Bank offices and began the process of taking control as it became clear the institution could not meet its withdrawal obligations. The Federal Deposit Insurance Corporation seal appeared on television screens across America as news anchors in studios reported that a federally insured bank had been taken over by government regulators. Within days, a second bank called Signature Bank in New York City also faced sudden closure as depositors and investors watching financial news networks began questioning the stability of other regional banks. Regional bank stock price charts on financial trading screens across New York fell sharply as investors sold shares in multiple institutions simultaneously, worried that what had hit Silicon Valley Bank might spread. Bitcoin price charts on trading screens responded in a direction that surprised many analysts. As banking sector fears grew on financial news stations, Bitcoin price actually began rising sharply upward, Bitcoin climbed from near $20,000 to above $28,000 within a matter of days, as some investors and traders moved portions of their holdings away from traditional bank accounts toward digital assets. Financial commentators on television sets across America debated what the Bitcoin price rise during the banking crisis actually meant for the longer-term relationship between digital assets and the traditional system. The original design documents behind Bitcoin, written by its anonymous creator and published online in 2008, had described the cryptocurrency as a system designed to operate outside of traditional banking institutions. Printed copies of the Bitcoin founding document circulated widely on social media platforms during the March 2023 banking crisis, shared by people who pointed to it as evidence that the design intention had been fulfilled. The Federal Reserve and the United States Treasury Department in Washington, D.C. announced emergency measures guaranteeing all deposits at the failed banks, going beyond the standard insured limit at that time. The announcement from Washington, D.C. that all depositors would be made whole calmed markets temporarily as bank stock price charts on financial trading screens recovered some of their sudden and sharp losses. But the March 2023 banking events had introduced a new and uncomfortable question into financial discussions happening inside offices and living rooms across the country and around the entire world. If central bank interest rate increases could cause a banking institution to collapse by eroding the value of its government bond holdings, what other hidden pressure points existed inside the financial system? Financial regulators in Washington, D.C. began examining printed balance sheet documents from regional banks across the United States, looking carefully for other institutions that might face similar bond portfolio problems. The Office of the Comptroller of the Currency in Washington, D.C. published review findings suggesting that unrealized bond portfolio losses were spread across a much wider number of institutions than had been publicly known. Unrealized losses mean that an institution holds an asset that has declined in value on paper, but has not yet sold that asset, meaning the loss has not yet formally appeared on the official financial statements. Economists at university research buildings across the country published analysis papers arguing that the Federal Reserve rate hike campaign had created a hidden vulnerability spreading quietly through the banking system. Against this backdrop of banking stress and central bank pressure, Bitcoin price charts in the spring of 2023 continued to move upward, passing above $30,000 for the first time since the summer of 2022. The Bitcoin price recovery from $16,000 at the start of 2023 to above $30,000 by April represented a doubling in value in under 4 months, a move that appeared prominently on trading screens everywhere. Bitcoin supporters in online communities and at technology conference stages in San Francisco argued that the asset was demonstrating exactly the behavior its design had intended during periods of institutional instability. Critics of Bitcoin, watching financial news networks, responded that the price movement was speculative and temporary, and that the asset remained highly volatile with no guarantee of continued upward price recovery. Both sides of the Bitcoin debate published their arguments in financial media, on conference stages, and inside congressional hearing rooms in Washington, D.C., where lawmakers debated the future of digital asset regulation. Congressional hearing rooms in Washington, D.C. featured executives from major cryptocurrency companies sitting before lawmakers at long tables, answering questions about the safety and regulation of digital assets. Lawmakers on the Senate Banking Committee in Washington, D.C. questioned cryptocurrency exchange executives about customer protection, asset backing, and the transparency of digital asset company financial records. Cryptocurrency exchange company executives sitting before Senate Banking Committee members in Washington, D.C. held printed documents and spoke carefully into microphones about regulatory compliance and consumer protection. The collapse of a major cryptocurrency exchange called FTX in November 2022 had preceded all of these hearings, adding urgency to the congressional discussions about what rules should govern digital assets going forward. FTX had been one of the largest cryptocurrency trading platforms in the world, processing billions of dollars in transactions daily from trading floors and offices located in the Bahamas and around the globe. FTX customer account screens had shown frozen balances in November 2022 as news spread that customer funds had been reportedly misused, and regulators in multiple countries began simultaneous investigations. The collapse of FTX affected Bitcoin price charts on trading screens by pushing the cryptocurrency back down below $17,000 in November of 2022, adding another layer of turbulence to an already difficult year. Printed regulatory filings and court documents from the FTX legal proceedings that followed became some of the most widely read financial documents of 2023, distributed across news outlets worldwide. Court documents from the FTX proceedings in United States federal courts contain details about financial practices that financial regulators and lawmakers in Washington, D.C. publicly described as deeply troubling. Against this backdrop of regulation, collapse, and recovery, the global inflation story that had begun this documentary was itself evolving in ways that would once again bring central banks back into the conversation. By the middle of 2023, inflation rates across most major economies had declined meaningfully from their peak levels, appearing on official government-printed charts in lower positions than the prior year had shown. The Federal Reserve Building in Washington, D.C. paused its rate increase campaign in June of 2023 after having raised interest rates at 10 consecutive policy meetings, one of the most concentrated campaigns in history. The pause was displayed prominently on Federal Reserve press conference screens as Jerome Powell stood before cameras and explained that officials would now assess the full impact of previous increases on the economy. Financial market screens across New York, London, and Tokyo responded to the pause announcement with upward movements as traders interpreted the news as a signal that the most aggressive phase of tightening was complete. Stock market screens at the New York Stock Exchange showed the S&P 500 index recovering significantly through the second half of 2023, climbing back toward levels that the bear market of 2022 had wiped away. Bitcoin price charts through the second half of 2023 continued to recover, trading consistently above $25,000 and making periodic attempts to push above the $30,000 threshold on trading screens. A major development in the Bitcoin story arrived in late 2023 when multiple large financial companies filed formal applications with regulators in Washington, D.C. to create Bitcoin exchange-traded funds. An exchange-traded fund is a financial product that trades on a regular stock exchange like the New York Stock Exchange and allows investors to gain exposure to an asset without directly holding that asset. The idea of a Bitcoin exchange-traded fund had been proposed to regulators in Washington, D.C. multiple times over many years, but had been rejected on each occasion, citing concerns about market manipulation. The new round of applications in 2023 came from some of the largest asset management companies in the world, with offices in buildings on and around Wall Street and across the major financial centers globally. The prospect of a Bitcoin exchange-traded fund approval sent price charts on trading screens sharply higher in late 2023, as investors anticipated that approval would bring enormous new pools of capital into the market. Bitcoin price charts closed the year 2023 near $42,000, recovering dramatically from the low of $16,000 at the start of that same year, a recovery that appeared boldly on financial tracking screens. The contrast between the $16,000 Bitcoin price at the start of 2023 and the $42,000 price at its close appeared as a dramatic upward line on charts printed and displayed widely across financial media. The recovery of Bitcoin through 2023 was not experienced evenly. Many individual investors who had purchased the asset near its all-time high of near $70,000 in late 2021 were still holding losses on their screens. Brokerage account screens belonging to investors who had purchased Bitcoin at or near $70,000 showed positions still deeply in the red even after the 2023 recovery, a painful reality printed on each statement. The broader inflation story was also not finished. While official printed charts showed inflation falling in the United States and across Europe, the prices of everyday items remained far above pre-2020 levels. Grocery store price tags across supermarkets in cities from Chicago to London to Sydney remained significantly higher than the same tags had shown in 2019, a persistent and visible reminder of what had occurred. The cumulative effect of the inflation shock of 2022 and 2023 meant that even as the rate of price increase slowed, the absolute price level consumers faced at checkout counters had permanently shifted higher. Economists and university research offices published papers explaining the difference between the rate of inflation, which had fallen, and the price level, which remained permanently elevated above earlier standards. Political conversations in government buildings, from the United States Capitol in Washington, D.C. to the House of Commons in London, increasingly focused on the cost of living as election cycles approached. Town hall meeting rooms across American states filled with citizens asking elected officials printed questions about grocery prices, housing costs, and energy bills that remained far above what families had planned for. The January 2024 approval by the Securities and Exchange Commission in Washington, D.C. of multiple Bitcoin exchange traded fund products became one of the most consequential financial regulatory decisions of the decade. The Securities and Exchange Commission building in Washington, D.C. published official approval documents that immediately appeared on financial market screens and sparked one of the largest single-day trading volumes ever. Within days of the Bitcoin exchange traded fund approvals, hundreds of millions of dollars flowed into the newly listed products trading on exchanges in New York as large institutional investors accessed Bitcoin for the first time. Bitcoin price charts responded to the exchange-traded fund launch by climbing powerfully in early 2024, breaking above $50,000 and then above $60,000 on trading screens for the first time in years. By March 2024, Bitcoin price charts on financial trading screens showed the cryptocurrency trading at and then above its previous all-time high of approximately $69,000 set back in November of 2021. The moment Bitcoin crossed above its previous all-time high on trading screens in March 2024 marked the first time the asset had reached that level since the beginning of the inflation shock cycle that had begun in 2021. Financial history shows that Bitcoin had now navigated its first encounter with a synchronized global central bank tightening cycle, the inflation shock of 2022 that had driven 7 central banks to act in 1 week. The story of Bitcoin surviving the inflation shock of 2022 is not simply a story about a digital asset. It is a story about what happens when governments print enormous amounts of money and then try to take it back. Printing presses inside United States Treasury facilities in Washington, D.C. had expanded the money supply dramatically in 2020, and the consequences of that decision rippled through every market on the planet. Central bank buildings on 6 continents responded with historic synchronized rate increases that shook bond markets, crushed risk assets, closed banks, and tested every investment strategy simultaneously. The global economic system that emerged from the inflation shock of 2022 through 2024 was fundamentally different from the one that had existed before the printing presses of 2020 had begun their historic run. Bitcoin price charts, bond yield screens, bank balance sheets, and grocery store price tags all carried the permanent marks of the inflation shock, visible reminders of what happens when money supply and real goods diverge. If this story moved you, hit subscribe button. The past holds powerful lessons, and I will help you uncover them.